You've got some thoughts in terms of what to expect for 2026. What are some of the key themes investors should be watching?
Sure, Leslie, and thank you, and good morning. And I love being the first guest of the year. So for 2026, we have three key themes, and this is what we're telling our advisors and clients. So first one, the economy for 2026 proves to be stronger than expected. And there's many reasons, fiscal stimulus and monetary stimulus. The Fed's cutting rates. Also, from a fiscal standpoint, the big beautiful bill introduced some retroactive tax cuts. IRS did not update withholding rates. So if you kind of flow this through, about 6 million more Americans should get refunds this year, increasing by about $500 per average. You flow this through with about 70% spend rate. GDP in the first quarter should be up about 0.5% relative to expectations. Second of all, we have low inventory to sales ratios, great for manufacturing, and rising economic productivity. So good news. But our second theme, we're a little bit cautious. We do expect below average returns for the S&P, about 4 to 6%. The good news, the economy is better. We have a solid market backdrop with oil, dollar, yields, and multi-year lows. Earnings looks great, but here's the bad news. High valuations. The forward PE is around 22.5 times, pretty close to record highs, little room for multiple expansion. We've got seasonality. We are in the second year of a presidential cycle, tends to be pretty weak. Since 1960, it's averaged about 2%. And we have a pretty big Fed divide. The markets expect 2 or more rate cuts. The Fed says 1. And here's our third theme. With all this taken together, market leadership, as we're seeing already, should continue to change, move away from mega caps. We have high valuations in mega caps, especially at tech. Valuations are pretty attractive, especially in the S&P equal weight. And here's the crux of it all. When the Fed historically has cut rates, market breadth has widened. Mid tend to do well, value tends to do well. And this is where we're over within our portfolios right now.
So then, do you think that the broadening will bring the market higher? I ask that because the concentration of the markets, while many see it as a risk, has definitely served the broader indexes well over the past 3 years. So can the rise of the rest essentially make up for, that breadth in terms of overall index performance?
I think it will. I just think it's going to be a very cautious move high. I think there's going to be a lot of stops and starts, especially as we head into midterm elections, especially as we hear from the Supreme Court in terms of the President Trump tariffs. I do think there's going to be a lot of near-term market volatility as we navigate this. I mean, you talked about this earlier. Look at like the last 4 days, markets have been pretty weak as we start to get this uncertainty near year end. I mean, I look at Wednesday, market breadth was pretty bad. The advanced decline line was negative 467. That's an ugly number. So we have a lot of things weighing on the market. But I think the good news is as market breadth widens, we won't see the big gains as we've seen in the last 3 years, but we'll see a nice muted gain. And after 3 straight years of over double-digit returns, I'm okay with a mid-single-digit return this year.
So you think it's time to diversify. Your favorite sectors are technology, healthcare, and industrials. That's the play with this kind of broadening out of the market?
Yeah, I mean, technology seems a little strange to be a broadening out of the market, but I do think, yes, I admit there are valuation concerns, but AI remains in the early innings of the build-out phase. You have massive investments in data centers, cloud infrastructure, and you think about this, we're watching productivity gains. Historically, productivity is the biggest driver of long-term market returns. We've not really seen this in the data yet. Healthcare, valuations are still pretty attractive. We have aging demographics, managed care demand, and then industrials. We just upgraded this a few weeks ago. Industrials, yes, I admit, third best performing sector this year, but you're getting more support in this sector from energy infrastructure investment, reshoring of supply chains, AI demand driven investments, and really just big defense spending. So those are our 3 favorite sectors right now.